How you guys doing? My name is Witchell Joseph. I'm not a financial advisor, so everything here is for educational purposes. All right. So we're gonna start off going to some terms because it came to my attention. A lot of people don't understand the basics. So we're going back to basics and then we're gonna build from there. All right. So number one, if I was to ask somebody what is the option, who can explain to me what is the option? Somebody, I need a volunteer. What is the option? Anybody want to take a stab at it to explain what is an option? No, nobody's feeling brave. All right. So an option is a contract. All right. It's a contract. So there's two different types of options. There's call options and there's put options. So a call option, it gives you the option. Right here it says it gives you the right, but not the obligation. So just to simplify that, it gives you the option to buy shares of a stock at an agreed upon price by or on or before a particular date. So to simplify that, it's a contract that gives you the right to buy shares of a stock at a set price by a set date. Is that clear enough for you guys? All right. So next you have put option. Put option is the same thing as call options, but in reverse. So put options give you the option to sell shares by at a set locked in price by a set time known as the expiration date. The particular date at which the option contract will expire. That's the expiration date. Now strike price, that's the agreed upon price at which the stock will be bought or sold. Any questions? I want to make sure you guys get this part because it's the basics. You guys understand this? Oh, let me go back. You guys understand this part?
Yes, I understand it.
All right, good. All right, so now let's talk about how it works in detail. So let's talk about call. All right, so this is a scenario. You have a call option, right? The strike price is 120 and it expires in 30 days from now. Only thing that matters is that you're locking in the right to buy it at 120. Letting somebody 1 second. All right. So like I was saying, so the option is a contract. It gives you the right to either buy or sell 100 shares of stock by a certain date, you know, and you're locking in a certain price. So you're locking in the $120 price. And now by buying this call option, you have the right to buy it at 120. So now let's say the price goes up to 135, you still have the right to buy it at 120, and that difference is your profit. Any questions? This is pretty clear for you guys? So you guys understand the basics of options, and if this is pretty clear. All right. So this is an example of a call option. You make money once it goes up, you're able to buy it at a cheaper price. So now the value of your option increases. All right. Now let's talk about how do puts make money. So a put option is basically everything in reverse. So now same scenario, we're locking in the 120 price that for 30 days from now, anytime from now and 30 days into the future, we have this locked in at 120. So now owning a put option will allow you to sell stock. So you're locking in the selling price. All right. So now when the price drops, because you get a put option because you think the price will go down. So now when the price does drop, you still have locked in the higher selling price. So you're able to sell it at 120, even though it's going for 100. All right. That makes sense to you guys? Good. So now, why would somebody get an option? This is why somebody would get an option. Because if you want to buy 100 shares of the stock, you're going to have to put up the total amount that it costs to buy that 100 shares. But with the option at a fraction of the cost, you can control 100 shares and still profit if it moves in your direction. Is this clear for everybody? Any questions?
So you were saying that you own 100 shares. It's just like the lower price. Is that what you meant?
So what I'm saying is you don't own 100 shares. You get to control 100 shares. So it's like option is like you're putting a down payment on 100 shares. Does that make sense?
Yeah.
Yeah. So your down payment for this, for example, like it might cost you 300, you know, but it 300, you can probably find an option for $300, right? At a certain strike price that's going to control like 100 shares. Does that make sense? So now if it moves up, you still get to make money, but you don't have to put in as much. Does that make sense?
Yeah, right. Because you had bought it at the lower price already. And you're controlling the 100 shares.
Yeah. So like an actual example, I needed a full example. Which one kind of explained it better? Okay, let me go back to the previous slide. Probably did a better job. So let's say this is one. All right. So the stock price when you first buy this, the stock price is 120. So I'm gonna do some math so you can see. So the stock price is $120 per share. Oh, they don't even actually give me the premiums that I wanted. I'm gonna have to make up one, huh? Hold on. I wanted the actual option price to show you. Let me go to a different slide. Let's go to which one? This one. This one. All right. So here's an actual example that I could actually use and show you real numbers. All right. So for example, they're looking at the $48 call. That's the strike price, right? So AMD is $48.75. If I buy 100 of this, it's going to cost me $4,875. So you see, this is how much money it would cost to buy 100 shares of AMD. All right. So now, instead of putting up all that money, what I can do is buy a $48 call, letting me locking in the $48 price. So now I lock in the right to buy it at $48. Guess how much it costs me? How much does it cost? Can you see that, Maria? Did you see how much it costs?
Yeah. So is that 274 or it's the two?
So it's listed as $2.74. But you got to remember, this is per share. One option contract controls 100 shares of stock. You have the right to.
So that's like why you were saying it was like getting it on discount because one contract controls 100 shares.
Yeah. So instead of putting up 4,800 to buy the 100 shares, I can own a contract that is worth $274. And now when the price goes up, my contract value will go up. So basically I can still get a position and participate on that move without having to put up the full cost of the shares. Make sense?
Yeah.
All right.
Right. 274 versus $4,000, obviously.
Yeah, it's a real big move. And what's beautiful about it is that when it moves, you make more money percentage wise. You know what I'm saying? So if like, for example, they have Greeks, right? Let's just say like if this Greek, let's just say this had a 50 delta, right? I'm just saying, for example, let's say this had a 50 delta, right? So if this had a 50 delta, if if this goes up $1, so instead of 48, not 48.75, this goes to 49.75. Let's say the price goes up $1, right? So now think about this. If the price goes up $1, this goes up by $1, then you'll make $100 because you have 100 shares that goes up by $1. So your profit right here is plus 100 on your shares. You made $100 off your shares by moving up $1. But now with this delta being at 50, I would make a profit of $50. You see what I'm saying? So you might look at, oh, $100 is more than 50, but you have to put up this much to make 100. So that's a smaller percentage return versus $50 out of 274. That's a much bigger percentage return. So you're able to make more money with less, basically, if that makes sense. All right, so while we're here, I guess we could talk about it. All right, so I have to explain this to you guys. So when it comes to the premiums is what we call these. These are all premiums. When it comes to the premiums, they're made of, the pricing is made up from two sides: intrinsic value and extrinsic value. All right. So now let's first talk about intrinsic value. All right. So intrinsic value is the profit you would make if you were to exercise the contract right now. So for example, this right here has 75 cents of intrinsic value. How do we figure? Like this, because the price is, I don't know if you can see this, I'll write it bigger. The price is 48.75, right? So think about it like this. If I bought this call option right now, I would have locked in the right to buy it at 48. Now let's say I exercise it. I exercise my contract. That means I buy the 100 shares. So I buy 100 shares at 48. Guess what? That would cost me 4,800, and that would leave me with $75 in profit. Does that make sense? I want to make sure this is clear. So this 48, right? Let me use a different color. If I bought 100 shares, it would cost me $4,800. And if you remember before, this cost $4,875 to buy 100 shares. So therefore, I would make 75 in profit. Therefore, this has 75 cents of intrinsic value. Does that make sense to you guys? Not necessarily an easy concept.
Yeah, I see what you're saying.
It already has value. Intrinsic value is when your option already has a value presently. Like if right now you exercised it, you're already in the money. All right. Now, that is a portion of the premium. The other portion of the premium of the cost of the option comes from extrinsic value. Now, extrinsic value has to do with time till maturity, is broken down to time till maturation, and implied volatility. So time till maturity, if you look at that, that's just time. So you gotta understand, time is what gives options value, because if you have enough time, the price might just reach there. Does that make sense? You're paying for time. The other part that you're paying for is implied volatility. Implied volatility is how much is it going to move. But you got to understand that without time, there's no implied volatility. Let me stop right there because I don't want to lose anybody. Do you guys understand what I mean by that? Any questions, anybody? Everything's clear? All right, I'm just gonna assume everything's clear. So understand that whenever you pay for an option, what you're paying for is broken down into two sections: intrinsic value and the extrinsic value. The intrinsic value is how much the option is worth as is in the current moment. The extrinsic value is the time that you're paying for, and the implied volatility. All right. Any questions?
Yeah, I had a question. How do you calculate what the extrinsic value is?
So it's not going to be easy to, well, put it like this. Once you calculate the intrinsic value, whatever's left is the extrinsic value. You understand?
Yeah, that's the difference between the $1.99 and 75 cents is your 274.
Yeah, the difference. Yep. So for example, you see how this is, I'm gonna make this, I'm gonna fudge the numbers a little bit and make this even simpler. All right. So let's say now this price is actually going to be $49. I'm gonna make this 49. The stock is $49 right now, right? So now if it's $49, can you tell me this $48 call, how much intrinsic value does it have?
It'd be 1.0.
Yep, 1.0. It'll be because it's $1 in the money. So you have $1 of value already without doing anything. So you gotta understand once you're in the money, you if let's say expiration comes and you're in the money, you don't lose this. What you do lose is the time. You lose this, like when expiration comes around. So by the time expiration comes, you don't have any more time, and time is what makes everything possible. So the reason why certain contracts will be worth something is because they have time. Once the time is gone, they're almost worthless, or maybe they might have a little bit of intrinsic value if they do. But that's what I want you to understand. All right. And implied volatility. So let's talk a little bit about implied volatility, because you have to understand that stocks do not have implied volatility. Options do. What do options have that stocks don't have, so that options have implied volatility? Can anybody answer that? Why do stocks don't have, why don't stocks have implied volatility? There we go. Anybody? Why do you think stocks don't have implied volatility, but options do?
Because stocks don't give you the time. Stocks is basically buying it right then and there. Or owning it flat out.
What are you implying if you don't have time to imply it, right? Exactly. So because the options have expiration dates, they have implied volatility. Stocks have historical volatility as based off the history of the stock over a year. Implied volatility is based off of expiration date that happens every week or every month or every so often. So that's the difference. I feel like you guys did pretty good with this. I thought it would be a little harder to explain. But yeah, so you guys understand the breakdown of an option contract. You guys understand intrinsic value and extrinsic value. All right. Let's go into the bid-ask spread. Let me erase these. All right, good. All right. Does anybody understand the bid-ask spread already? Can somebody tell me, how does the bid-ask spread work?
Do you find the price between the bid and the ask, and that's what you're actually paying?
And do you know what the bid and the ask are?
One is like the buy and the other is the sell price.
Yep. So at all times, there's two prices that are there's always two prices for everything that you buy. So the market's always going up and down at the same time because of the bid-ask spread. Yep. So now so let me ask you, so if there's a spread, right? Let's say if there's these two prices and they have to meet in the middle. So who gets the extra money in the spread? Who gets that? Like, for example, this one is 220, 224.
Broker.
Say it again.
The broker.
Exactly, the broker slash market maker. So the market maker never loses because they always get the spread for every trade. Their job is just to facilitate the trade so that there's actually people and buyers and sellers to actually make the trade go down. All right, so in this example, the spread is the 3 cents, and you see that that's what goes to exchange. Now you understand, doesn't matter the scenario, like they're always getting 3 cents. So for example, let's say somebody wants to buy and they're asking for $2.27. You could either buy it at 227, or you can try to buy it for 226 and see if the seller will come down to you. So that way you only giving up 2 cents per share, or $2 versus the whole 3. So that's the bid-ask spread. All right. All right, so sometimes you'll see this happen, and this is something that gets a lot of people, and they don't understand. So like, you already know between the bid and ask spread, they're gonna try to meet in the middle. So what will happen sometimes you'll see an option where it's like only going for $1, or it's only going for $0. It's going for like, it's significantly cheaper than all the options around it. Make sure you go check the bid. Make sure you go check the ask, because a lot of times there'll be no bid. So basically that means that there's no buyers. So let's say you have bought this $50, but then at the end of the day you see that your option is going for 100. So you think you made $50. Like, no, you didn't actually make any money. It's just because that there's no buyers and there's such a big disparity between what people are asking for. It makes you appear to have made money. Any questions on that? I don't know if you guys ever got caught in these situations. No?
I want to make sure I understood it right. You said if the bid say 0, that basically means that, you might have thought you made some money, but since ain't nobody buying it, you basically got to sit and hold. Is that what you mean?
Yeah, yeah, and until a buyer enters the market, it's like this number means nothing. Like you be like, I'm at $100. No, it appears to. The only reason why it seems like you're at $100 is because this person is asking for too much. They jacked up the price that they wanted to ask for, which is pointless because there's no buyers. Does that make sense?
Yeah.
So therefore, so every time you're checking the option and you see a price, like sometimes you'll see them only going for $1, but then you'll see like the ask is so far from, and the bid is 0, and that's why somehow the mid price they're asking for $1 somehow, But that's the main thing is, so every time you trade an option, you want to make sure it's liquid. The way that you know it's liquid is when you have a tight spread. Because when it's tight, it's easier for the sellers and the buyers to agree on the price because it's tight. But when they're wide, then the sellers and buyers are not agreeing on price. And one thing that shows you that is volume. So when it comes to liquidity, number 1, you look at the spread. Number 2, look at the volume. Because if there's low volume, there's going to be a wide spread. But the more the volume, the tighter the spread. All right. And then, so if you don't know, volume is just the number of contracts. It's the number of contracts traded. All right. And open interest, it's the number of contracts that are still open. It's still open. Any questions? Any questions, people? You guys understand volume, what's open interest, and why it matters? I'll take it that you guys get that part then. All right.
Yeah, I I got it.
Cool, cool. You guys are quiet this evening. Clear all. All right, so talk about that. All right, let's talk about this. All right. Implied volatility. All right. So implied volatility is probably the most important topic when it comes to options, because that's what really helps us to make the money, is what people are thinking is going to happen versus what actually happens, and us being able to chart what could really happen for us. So what you got to realize is this is volatility. This is what implied volatility. So if you were to look on a chart and you look at implied volatility, you would see something like this, right? And what you're gonna notice is that there's an average. Like if you go across this middle line right here, you'll see that this is the mean. This is the average. So when I say mean, what I mean is average. All right. So this is the average of implied volatility. And what you're gonna notice is that implied volatility goes up, it goes down, and when it goes down, it goes back towards the average. Then it'll go up higher. Then it's gonna go back down towards the average. Then it's a little bit lower, but every time it's reverting back to the average. And this is what we call mean reversion. This is just, you're always going back to the average. And that's the thing you're gonna notice with these instruments, is that they love to go back to the average. So what this does, this gives us an edge, an opportunity, because what we want to do is we want to buy when implied volatility is low, and we want to sell when implied volatility is high. All right. So basically what you have to do is so you got to understand, like, let's just say you have an option and it doesn't move, everything stays the same except for implied volatility. Implied volatility going up or down by itself will change the value of your options, because there's something that happens around earnings called volatility crush. Because of earnings, people have all these expectations. Implied volatility is high, it's high, it's high. Then once the earnings comes, the numbers pop up. There's no more implied volatility. People already know what it is. There's no more guessing. So now implied volatility drops. So now let's say you have an option, you have a call, the price is going up, it's going in your direction, but the implied volatility dropped on you. So even though the price is going up, you would still lose money. Did you guys catch that?
I did not.
All right. So what I'm saying is that implied volatility, so when implied volatility is up, it's more expensive. The options are more expensive. It has a higher value. I'll say higher value, right? So there's more money. I'll just put it like this, right? More money, right? When implied volatility is down, it's less money. You understand? So it's more money when implied volatility is up. It's less money when implied volatility is down. So implied volatility is a whole separate stat, a whole separate metric. So this moves up and down depending on what people expect, what people think is going to happen. All right. So now let's talk about earnings. Earnings is a special event when the stock is going to do a report to the shareholders and let them know whether they beat earnings or whether they didn't beat earnings. All right. So now, before that earnings call happens, people are expecting a lot of things. So because of that expectation going up, implied volatility goes up. When implied volatility goes up, the value of your options go up without nothing else affecting it. You guys understand? Following me so far?
Is this the reason like people don't trade on news days then?
Sometimes, yeah, exactly. Because the volatility is you can get crushed in the volatility. You can get crushed in the volatility. So what happens? So think about it like this, right? Volatility is going up, let's say news or earnings is happening, you buy right here, and guess what happens? The price can still keep going up, but implied volatility is going down. So now your option is becoming less and less, even though the price is going up. Because that implied volatility drops suddenly. That makes sense? Questions, guys? I know you guys got questions. Clear?
I'm kind of confused about how it goes up and down at the same time.
Well, this is like over time. This is just over time. Like, because implied volatility, like as the days are going by, like these are all like days, it's gonna go up and down as time goes by. Because what is implied volatility? The expected move, the expectations are gonna change. So that's why it goes up and down over time. Is that clear? Clearer?
Yeah, but you were saying that like even though the price go up because news come out, the volatility will still drop. You're saying basically the expectations were too high already to even catch where it's supposed to be.
So let me give you a live example. I think you need like a live example. Let me just go into make this easier. I'm gonna Robinhood real quick, real quick, so you can understand the metrics and how it's affecting what's going on. Because implied volatility is a metric like delta, like beta. It affects the price of the option. So when that goes up and down suddenly, it doesn't matter. Like it's gonna affect the price on a big way that the theta, I mean the delta that you would make from the price going up isn't even enough to combat what you're losing. So let's just go to one. I don't know. Let's go to something with low volatility. Let's go to AT&T. Oh, are you guys able to see my screen still? You guys still able to see my screen?
Yeah, I could see your screen.
So I'm gonna go to AT&T. I'm gonna go to a random option so you can see the metrics. Let's say I'm trading this, right? Let's say I'm trading this, and I'm gonna go to a random option. Let's just go to this one right here. All right. So you see, so here's what you need to pay attention to. Right here, implied volatility, and right here is Vega. So this is not a very volatile stock, so it's pretty low numbers. But the thing is, this is what Vega means. That means if this goes up 1%, this is how much it makes. So every time this number goes up 1%, your option will gain 40 cents. You understand? So now if this goes down 1%, your option will lose 40 cents. Does that make sense? I should go to a better.
Yeah, basically that. Well, because I didn't know about the Vega one. I seen you talk about the delta and theta, but basically you're saying the implied volatility still affects the overall price, like of what we're gonna be.
Exactly. So let's just say like this data, this delta was like smaller. Let's say this delta was like 0.0012. I'm just doing this for example purposes. And then now you seeing that your deltas, you're making 12 cents, but every time this moves, you're losing 40. You see what I'm saying? So now the price can go in your direction, but because the implied volatility dropped, your option will lose money. Make sense?
Yeah.
So it's all about how the stats.
Two different sides.
Say that again.
I said it's like it's on two different sides. How you were saying, okay, so you get the 12 cent, but that's why I wasn't putting the two together because I see what you're saying now.
Yeah, because at the same time, if it doesn't move, you're losing $4.20. So you have to look at everything, all the stats and how they're like, you know, cooperating with each other. How are they moving to each other? Because a lot of times it's this versus this. It's like, how much money can I make versus how much I lose per day? You know what I mean? But then people forget, well, if implied volatility goes up, nothing could happen, I still make money. If implied volatility goes down, nothing could happen, I still lose money. So this is something that a lot of people don't know. And I really want to share this with you guys because this happened to me before when I was trading like Nike around earnings. And at one day it just shot up, it doubled, but then the next day, like it just went down even worse, you know? And this is why. So that's basically all I had for class for you guys. I got about a minute left. So definitely if you guys are interested in the recordings, sign up for my coffee page. I also do one-on-one coaching for those that are really interested about seriously understanding and taking their trading to another level in 2021. So I thank all you guys for coming to class and supporting me.
You already know.
Thank you. Great job.
You're welcome. You're welcome. All right. Enjoy your trading tomorrow and into the next year. Happy New Year, everybody. I'm out of here.
You
All right, peace.